everyone, and welcome back. You're watching The Money Show, and here's introducing The Money Show's ICICI Prudential ETF Corner. We're going to be touching upon different aspects of ETFs, which, as we know, are exchange traded funds. Now, we know that an ETF is a passively managed fund that does tend to mimic or ape the constituents of a particular index. But what if we were to tell you that there are certain kind of ETFs that actually may also have the potential to perform better than the market? These are what we call as smart beta strategies or smart beta ETFs. To take this conversation further and to talk about this concept a little more, I have with me Chintan Harya. He's the head of products and strategy with ICICI Prudential AMC. Chintan, a pleasure having you with us today on ET Now. Thanks so much for joining in. So tell us a bit about this smart beta strategy. It sounds very interesting because what essentially you're doing is you're giving me the best of both worlds. You're giving me the best parts of an ETF, its low cost, the fact that it's a little passive in nature, and then you're giving me the returns aspect as well, the outperformance in returns rather. So how does it work? Why don't you just start by introducing that to our viewers?
Yeah, sure. To just thank you, and thank you all to the viewers as well. So if we see what is smart beta, like you mentioned, it's a very simple concept wherein in an ETF, if you actually select the stocks in a manner where you are basically taking up a factor and selecting the stocks, that's essentially smart beta. So if we see the evolution of investing, there were active funds followed by index funds, followed by ETFs. And then within ETFs, there was a concept of smart beta, which is basically gaining popularity in the last 10 years or so, especially in the international markets and now in the Indian markets as well, as more and more people are getting aware. It's a simple concept wherein while in a normal index fund or an ETF, the selection of securities is basis the market capitalization, top 50 stocks, top 30 stocks. In a smart beta concept, what we try to do is select the stocks with keeping some factor in mind. And when that factor does well, that smart beta index or ETF has the concept, has the potential to actually do better than the market cap weighted indices.
But it has this, the similar nature or a similar construct of an ETF, namely low cost, easily liquidable.
Yes, so all the other features remain the same, right? They are traded on the exchange. You can buy and sell in small unit sizes, right? Not everyone necessarily needs to have a larger corpus to invest in. So if, say, a smart beta ETF may be trading at between, say, 100 rupees, 200 rupees, depending on which ETF you're talking about, you can basically trade that in small units as well as larger units. Liquidity is there on the exchanges, which can be provided by authorized participants as well. And as we grow along and as the concept becomes more popular, when more people come in, the liquidity will also obviously improve. In India, it's still at a nascent stage, but globally we've seen it picking up significantly, especially the dividend yield smart beta ETFs, wherein high dividend yielding stocks are selected in an ETF, and they're becoming popular because, as you know, globally there is 0% interest rates, and in that, dividend yield is becoming a good factor. In India, there are other factors which are becoming popular, but we'll come to that when we speak about the factors. Thank you.
So how have returns been? I mean, I know in India it's still at a bit of a nascent stage. ICICI Prudential has just started this concept really, but globally, what sort of performance have they delivered? How have they done? And of course, keeping in mind that past performance is no guarantee for future return as a caveat for our viewers.
Yes, I think the performance is determined by which factor a particular smart beta ETF is actually based on. So let's take an example, which is, I'll take two examples which are stark, right? In the last 5 years, if there was a growth-oriented smart beta ETF, in other words, you picked up those stocks which had high quality earnings, and those are typically called as growth stocks, and you made an ETF out of that, that would have done very well over the last 5 years. Similarly, if you would have, on the other hand, had a value portfolio, in other words, you would have picked up those stocks which are currently going through a temporary downturn, those value portfolios would have underperformed. So it depends on which ETF you actually end up choosing, and that's where I think a large section of the audience or investors in ETFs are evolved enough to actually know which factor they want to invest in. And there are various factors. I mentioned value, I mentioned growth, it can be alpha, it could be low vol. In India, we've seen, of course, low volatility as a concept working very well in the last maybe 5 to 10 years. That could be, again, because of the nature of how the market is. So I'd basically like to say that each factor has its time in terms of when it does well and when it does not. So from an investor perspective, if they can pick up the right factor, it will end up adding to their overall portfolio construct and help them in terms of diversification as well. So currently, as we speak, the low vol as a factor has been doing well in India. And we're seeing basically traction in terms of investors wanting to look at the low vol ETFs.
So in India, what sort of style or what sort of factor are smart beta funds largely, based on? If you could share that with us.
Yeah, so if we look at the first Smart Beta ETF that was launched in India was based on value, wherein there were 3 or 4 factors combined, which is price to earnings, price to book, return on capital employed, and dividend yield. Those were the factors through which the stock selection was happening. Post that, of course, there was the low vol ETF, which was the first true to label Smart Beta ETF in the sense that the stock selection was also based on low volatility stocks. So top 30 stocks out of the 100 stocks were part of that selection, and the weightages also of the stocks were based on the factor of low volatility. So those stocks which were lowest volatile would get the highest weight. So not just the stock selection, but the weightage of the stocks was also in the ICICI Prudential Low Vol 30 ETF is based on selection, and weightages are based on low volatility. So that was the first true to label, wherein the weightages were also part of the construct of the ETF itself. And as we moved along, of course, we've seen the multi-factor ETF, ICICI Prudential Alpha Low Vol 30 ETF, which was recently launched, which is a combination of 2 factors, which is alpha and low vol. So I believe that there are multiple options within factors also, which can be coming up over a period of time. And as we've seen in the Western world, investors will have a wider bouquet of smart beta ETFs to choose from as we evolve.
And I understand ICICI Prudential as well has 3 of its own smart beta ETFs. But Chintan, we leave it at that. Thank you so much for joining us on today's ICICI Prudential ETF Corner. Quick break right here on the show.